In September 2019, the US financial system almost had a heart attack, and most people barely noticed. Let's talk about the repo market. Not the guy named Tony showing up at 2 a.m. to take your car, though what happened in 2019 had similar energy. Repo is short for repurchase agreement. It's basically a short-term loan, usually overnight. Financial institutions hold safe assets like government bonds, but still need cash for daily operations. So instead of selling those bonds, they use them as collateral. One side hands over the bonds, it then receives the cash, and agrees to buy them back the next day at a slightly higher price. That difference is the interest. Banks do this constantly. The repo market moves around $1 to $4 trillion a day. It is the plumbing of the financial system, boring and invisible, but absolutely critical. Like your Wi-Fi router, you barely think about it until it stops working. So what caused this potential crisis? Well, three things hit at once. First, corporate tax deadlines. Every mid-September, big US companies send massive tax payments to the Treasury. That shifts a large amount of cash out of the banking system in one go. Overnight funding conditions tighten fast. Second, Treasury bond settlements. The government had just auctioned off a fresh batch of bonds, and settlement day had arrived, meaning banks now had to actually pay for them. More money being pulled out of the system on the same day. Third, and this one had been building for years, bank reserves had been quietly running low for months. After 2008, the Fed pumped enormous amounts of cash into the system, but spent years gradually pulling it back out. By September 2019, banks were uncomfortably close to the minimum needed to keep things functioning. None of these would have caused a crisis alone. But all three on the same day was the financial equivalent of your electricity, water, and internet going out simultaneously. Except that house is Wall Street. Banks couldn't get overnight funding. Some reportedly couldn't get it at any price. That's like finding out your bank can't make change for a 20. The Fed stepped in fast. And to put that in context, this was the first time they'd done something like this since the 2008 financial crisis. That alone tells you how serious it was. On September 17th, the New York Fed effectively showed up and said, "We'll lend you cash, no problem." Offering up to $75 billion overnight, banks took $53 billion of it within hours, and rates started dropping the same morning. They kept that window open every single day for the rest of the week. But it didn't stop there. By October, the Fed raised the daily limit to $120 billion. Then they started buying $60 billion worth of Treasury bills every month on top of that, quietly pumping fresh cash into the system on a rolling basis. The whole operation ran until June 2020. Crisis contained, most people never heard about it. But here's the more interesting question. What if the Fed hadn't intervened? On day one, you probably wouldn't notice anything, but by day 2 or 3, the dominoes start falling. Banks stop lending to each other. Short-term credit markets, the ones companies use for payroll, inventory, and daily operations, start freezing. We're not talking hedge funds losing money, we're talking your employer potentially not having the money to pay you on a Friday. From there, confidence collapses. And in finance, confidence is basically the whole game. Once institutions stop trusting each other, they stop trading, markets seize, and stocks drop. The story goes from obscure market hiccup to 2008 level crisis, and the speed of it is what makes it so dangerous. This isn't a stock market crash where prices fall over days or weeks and people scramble to react. The repo market resets every single night, so if confidence breaks, it breaks fast. Each morning becomes a new opportunity for institutions to say, "Actually, we're not lending today." Do that enough days in a row and the whole system starts choking. The Fed wasn't handing out favors, it was stepping in to keep a crack in the system from becoming a full breakdown of the global economy. So why did it happen? That is where things get uncomfortable. Nobody fully agrees. Some blame regulation. After 2008, banks were forced to hold bigger cash cushions, which sounded reassuring, but those cushions weren't really spare cash. They existed to satisfy regulators and internal safety limits. So when stress hit, cash that looked available on paper wasn't actually available to lend. Another explanation points to the market structure. Hedge funds had been leaning heavily on repo to fund their positions for years. That worked fine while overnight cash stayed cheap, but once things tightened, the system discovered how many players depended on that daily funding, and how little slack there really was. Then 2020, COVID hit. The Fed went completely ballistic. Trillions of dollars injected into the system, and rates slashed to zero. The 2019 repo issues got buried under a much louder emergency, and the underlying question of how much cash the system actually needs was never really answered, just drowned out. The 2019 repo crisis didn't cause a recession or crash your 401k, but it was a warning shot. The plumbing can break down fast, and when it does, the Fed is basically the only plumber on call. And like any emergency plumber, they showed up, stopped the bleeding, and left the underlying pipes just as dodgy as before. If you made it this far, you now know more about the repo market than 99% of people. Bring it up at your next dinner party. Or don't. We're not responsible for your social life. Make sure to drop a like and subscribe for more.